Well, is buy and hold investing the best way to go? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Listen, I'm going to open up the lines. If you've got a question, you can feel free to call in. I'll take your question. Do you have a line open? 1-877-913-5357. 1-877-913-5357. You can also go to the website at www.prudentmoney.com. Once you get to the website, there is a link at the very top of the opening page that says Ask Prudent Money. Just click through there, send your question in. I'll get you taken care of. Very simple, a great way to get information. That's all at the website, www.prudentmoney.com. Now, for today, 1-877-913-5357 is the number to call. And I do have a line open. One thing I wanted to point out before we got too deep into buy and hold investing, and really the best way to go about doing that, is simply the price of gold. You know, gold has been on an absolute tear. In fact, I couldn't even tell you, I forgot to look it up, how far it's up this year, but just unbelievable, being going gangbusters. My two concerns is that people or investors are investing into gold because of what they call the fear trade. Because at the end of the day, I don't think that gold's going to do a whole lot for you, and maybe not so much what you think it's going to do. That's the first thing. The second thing is, along with that fear trade goes from the standpoint of a solid, stable investment. Well, when it's going up, we don't really think too much about that because we like what it's doing. But today, gold was down, at least when the last time I looked at it, was down over 6%. And that is not a stable investment. In fact, during the financial crisis, during a lot of times that stocks in general have gone down, gold has gone down as well. So it's like with anything, know why you're investing into precious metals, real estate, or whatever it might be that's kind of the alternative investment. And don't just rush in because you think it's going to go to the moon. I think we've got a little bit of a bubble-looking type situation with gold right now. It'll be interesting to see what happens. Just don't start feeling like the security, because remember, it can have big down days as well. This is Bob Brooks, 1-877-913-5357. Well, probably the most popular type of investment is buy and hold investing, where you always stay invested no matter what. Some other ways to talk about buy and hold investing, and most traditional financial advisors stick with this as the type of investing that they recommend, is that you're invested for the long haul, that you are not going to try to time the market, which I've talked many, many times that timing the market can look like changing your risk level, but there's a big difference between changing your risk level and timing the market. But it's all about investing for the long term. Stay invested. Typically, when you go see your advisor and the markets are down, maybe a bear market is happening, and they'll sit down, they'll tell you, the first thing you need to do is breathe. Second thing you need to do is relax. Third thing is you need to do is trust the markets, because what if you get out and the market goes back up? And that's a very valid response that brings about the investor into a a very uncertain spot. Well, what if I do miss the recovery? I get out at the wrong time. So, to me, for the business, the financial services business, it's telling clients that, and pardon me for saying this, but I do really believe this, that telling clients that you're just in it for the long term is not a risk management process. It's you need to have a way out, and to me, it's kind of a advice that well, anyway, can't remember what I was going to say, but does that happen to you late in the afternoon? But at any rate, just to be careful and know why you're investing in gold. It can be a great investment. You certainly don't want to invest everything into gold. It has, from an allocation standpoint, it does have some merit, and you can definitely see where it's worked. Now, it doesn't help that during financial crises, during any period like that, and you're probably wondering why I'm talking about financial crisis. I mean, you're probably thinking, well, Bob, haven't you looked at the markets? Can't you? Do you know how far it's up again this year after 2 incredible years in a row? Absolutely. And I think that we're heading into, if not already there, a bubble type situation. So it's good to talk about these things, just as somewhat of a reminder. But I'll never forget this. Back in 2008, during the financial crisis, Charles Schwab had a commercial. And of course, during any time where you have the market that is going down aggressively, like happened in 2008, you have a lot of communication coming out of the financial services business to their advisors and telling them what to say. And this theme that you're a long-term investor, you want to hold on for the long term. And you have commercials on TV. This one always stuck out in my mind. Charles Schwab. And if you're not familiar with who Charles Schwab is, he's probably top 10, one of the biggest names on Wall Street. Has a huge investment company. And it shows a town hall meeting where everybody's gathered to listen to Charles Schwab give his best advice. And they choreographed this perfectly. This commercial was, you could feel the intensity, the tension, the fear. And into the room comes Charles Schwab. And I'm like, wow, this ought to be really good. So he starts taking questions, and the questions start coming to him. What do I do? Do I stay in the market? Do I get out? Do I sell? Do I buy more? Do I stay the course? What? And all these questions were coming, and he got real quiet on the commercial. And Charles Schwab, is about to say something great, because the guy is a genius, Wall Street genius, and it's going to be good stuff. Well, it gets real quiet. The camera pans over to him, and he goes, and I promise you this, and I'm not making it up. He says, the market goes up, the market goes down, but it always goes up. That, my friends, is a great illustration of buy and hold investing. It does. It goes up, it goes down, it goes back up again, hopefully higher than it did the first time it went up. Goes down, it goes back up again, and repeats the process. And if you look at any 60 to 100 year chart of the stock market, it's done nothing but go up. So it really is tough to beat that argument. And unfortunately, I think within the confines of the financial services business, that advisors get a little bit lulled to sleep with that advice. Now, if you're an investor sitting on the other end, your advisor's telling you that, you start thinking, yeah, well, it has always come back. Maybe I just need to, not make an emotional decision. And remember, this is what we're always talking about. Emotional decisions and being careful that you don't make them. John Bogle also had something to say about the market in 2008. John Bogle he's passed on, God bless his soul. He's passed on about 3 or 4 years ago. But I was blessed and fortunate enough to get the opportunity to interview him on the program a couple times, a couple of books that he wrote. And this guy was if Charles Schwab's a legend, John Bogle is a super legend. And he pretty much is credited for making and building the mutual fund. He started Vanguard Investments. I'm sure you've heard of Vanguard Investments. I was watching one morning on CNBC during the financial crisis, and they were interviewing John Bogle. By the way, if you ever want to know how bad the market looks, but you're not really sure, just turn on CNBC and they'll have all the big guns on there telling you everything's going to be okay. It is really kind of funny, actually. But John Bogle had these words to say. He says, when you go out to your mailbox and pull out your statement, I'm going to leave it there. I'll get back to it. This is Bob Brooks, 1-877-913-5357. Up against the break. Stick around. We'll be right back. Hello, this is Bob Brooks. Proverbs 22:3 and Proverbs 27:12 are the exact same verse word for word. I call them the stewardship verses of risk. A prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. On the Prudent Money Radio Show, we teach about risk, how to identify it, how to figure it out, and what to do about it. We believe that to be a prudent steward, you have to be a good risk manager. Listen to the Prudent Money Radio Show on Bible School Radio 91.3. Prudent Money, home of the modern-day steward movement.
This is Rob Randall, your host and teacher of the Invisible War radio program. The Invisible War is the study of God's Word on how to walk in Christ's victory in the spiritual battles we face against the powers of darkness. Join me every Sunday morning at 9, right here on KDKR and KYJC in Commerce, your station for life.
Dynamic, practical, life-changing.
There's no point in going to church and not letting the Christ who gave birth to the church on the day of Pentecost change your life.
Join us each day as Pastor Paul Shepherd applies the timeless truth of Scripture to everyday life. It's destined for victory on this great station.
Weekday afternoons at 3:30 here on Bible School Radio, KDKR.
Welcome back. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. 1-877-913-5357 is the number to call. Talking about John Bogle, founder of Vanguard Mutual Funds. And his advice one morning before the market had opened was to, when you go out to your mailbox and you pull out your statements, they're in the envelope, walk to the front door, walk in the house, close the door, open the drawer of your desk, throw those babies out, put those statements in the drawer, close the drawer, and you'll be just fine. He says noise, just a bunch of noise. You don't need any of that noise in your life. You don't need to read your investments because you might do something you might regret. As much respect as I do have for John Bogle, I have tremendous amounts of respect for him. I disagree a great deal with that advice, because not that aspects of it is correct. And we go back to the emotional decision, what kicks off the emotional decision. You need to know how your accounts are doing. You need to know what is working, what's not working, what your risk level is. I always talk about what's your risk level. Today, I say the same thing. If you're concerned about what's coming down the pike, who knows what it is, we have a long list we can read off. Just know your risk level, because if your risk level is correct, you should not be making emotional decisions. Well, let's take but if you go back to the premise of buy and hold investing, and that you just stay the course, it is a tough investment philosophy to argue against, except when you consider three things. First, if you've stayed invested, I don't care if you're looking at your investments or not, but if you stay invested when you're invested a certain way and the market is doing the opposite, it's stressful. It is truly stressful. And sometimes people have a breaking point a lot sooner than others, and maybe they don't think their breaking point is that quick to come to, but it is. And so the first thing is, how will you deal with the emotion? Don't downplay it, because it's the real thing. Number two is habit. When you've been buying and holding for 25, 30 years, that's what you know. You've seen it work. You've seen it come back. And it creates a habit. You don't know how to invest any other way. And the most important aspect of buy and holding is that, let me go back to 3 and 2 first before we keep going on. The third one is emotion. The second one, well, having a little, we'll get back to that in a second. But, I know what the first one is right here for me. The first one is, how are you going to handle the transition of when you need money? And that's an awfully important decision to be making. When, let's say, you get 2 years before retirement, and you know in a couple of years that you want to retire, but you are in a situation where you've got to make choices, you've got to make decisions on how to do that. And most people don't know how to do it. Most advisors don't know how to do it. And it's handling that transition. And then if you do see things, if you've been in a real wild market like we've been in, you've been making money hand over fist, it's been easy money. You get to that last 3 to 5 years, you're going to start the process of taking money out of the market. Market still keeps on going up, and you start feeling a lot of anxiety, and you don't know what that anxiety it is. And it's called FOMO, the fear, FOMO, the fear of missing out. Now, this is a devious emotion that can wreck your financial future and keep you from making wise decisions. And especially in this day and time when the market is on such big display, and you got your neighbors talking about how much money money that they're making, and some of which can be true, some of which not true, or exaggerated. Let's say a better way to put that. But fear of missing out on the money that people are making just because you want to get ready for retirement. Maybe I'll stay invested another couple of years and get out a year before. When it makes total sense, and it's good stewardship to go ahead now and start backing off risk, even though you know you're leaving money on the table. And all that comes from is simply this. Now, this is really very important you get this. The fear of missing out, if you feel like you're missing out, you also are fearing that you're missing out on the last opportunity to make money. And there has never been a statement that is so wrong, or a belief that's so wrong, that if I don't make money in this particular uptrend, bull market, great time to be in the market, whatever you want to call it, if I don't make the money, I'm not going to get that opportunity again. It is such a false set of statements. There are tons of opportunities to make money. There were, even if you look back in the 1929, when the stock markets crashed, there was opportunities to make money. Now, that's a little bit of a drastic. Most people aren't going to go there, but there are tons of opportunities. If you look at the market, went down pretty aggressively this year for a small time period. After that, there was a great opportunity to make money if you invested at the right time. Or even sort of at the right time, there was a great opportunity to make money. So just because you're missing out on one trend going up doesn't mean that you're going to miss out on the next one, or the next one, or the next one, or the hundreds of opportunities that will be in front of you. Maybe hundreds is a little bit of a stretch. But there's going to be a lot of opportunities. That's my point. So don't let fear of missing out cripple you and create an emotional response so that you go and you start selling, or you buying, or you don't sell, or whatever it is. Just be careful. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, I want to invite you to go to the website, www.prudentmoney.com. Once you get to the website, there is a link at the top of the page that says Ask Prudent Money. Go through that link and just click through and ask me a question. I'll get you taken care of. That's all at prudentmoney.com. See, investments in times like that can be best on hope. And a person who's invested, and I always like to use this as an analogy, or experiencing a hurricane. It's such a great market analogy, because when you can see, just like a hurricane, that the winds that the weather pattern is starting to take a certain shape, and starting to look like a hurricane, and becomes a hurricane. And you don't know at what point that hurricane is going to hit land. You have an idea. You don't know how strong it will be. It could be really strong out in the middle of the ocean. It could come in. It could have dropped several categories and just hit as a tropical storm. You don't know that till it gets here. You can see all the risk in the market. And you can see all the risk, and you can see the potential for loss and the potential for another bear market crisis. You can see all that, just like you can see the hurricane. But by the time it really starts to act, much like when we've had bear markets in the past. The one in 2022, it really turned out to be a very weak bear market. And investors were promptly rewarded by it last counting this year, 2 additional years before that. So we will continue this talk, because there's more that I want to say. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Please go to the website, prudentmoney.com. Send in your questions because we are all out of time. Till we do meet again next time. Keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.